The concept of financial freedom has been co-opted. It has been distilled into a simple, intoxicating formula. Save aggressively, invest passively, and escape the drudgery of work by 40. It's a narrative sold in best-selling books and amplified across countless blogs and forums, promising a life of perpetual leisure, funded by a well-tended portfolio. But this narrative, in its seductive simplicity, obscures a more complex and costly reality. We, as professionals, as strategists, as individuals accustomed to analyzing complex systems, must look beyond the surface-level arithmetic. We must ask a more incisive question. What is the true all-in cost of financial freedom? The cost is not a number. It is not 25 times your annual expenses. That's merely the price of admission. The true cost is measured in unseen trade-offs, in miscalculated risks, and in the profound psychological burdens that the pursuit of this goal can impose. Yet today, we will dissect this popular ideal, moving beyond the simplistic calculations of the FIRE movement, financial independence, retire early, to a more sophisticated understanding of wealth, work, and life. Let's begin with the foundational premise. Financial freedom is typically defined as the point at which your passive income from investments exceeds your living expenses. The most common heuristic for achieving this is the so-called 4% rule. This guideline, derived from the 1998 Trinity study by 3 finance professors at Trinity University, suggested that a retiree could safely withdraw 4% of their initial portfolio value, adjusted for inflation, each year for 30 years with a very high probability of not depleting their funds. This simple rule gave birth to the inverse, the 25x rule, which states you need to accumulate 25 times your annual expenses to achieve financial independence. It's elegant, it's quantifiable, and for many, it becomes a financial North Star. But relying on this 30-year-old study as gospel for a 50 or 60-year retirement is fraught with peril. The original study assumed a portfolio of at least 50% stocks and a 30-year retirement horizon. What if your early retirement spans 50 years? What about the sequence of returns? The creator of the 4% rule himself, William Bengen, has since revised his own guidance, suggesting a 4.5% or even 4.7% withdrawal rate is now feasible under certain conditions, while prominent financial planner Michael Kitces argues that in today's market environment with lower expected returns, a rate closer to 3.5% might be more prudent for long-term planning. The very foundation is not as solid as we are led to believe. It is a probability, not a certainty, and it ignores the most significant costs. The first and perhaps most insidious of these costs is opportunity cost, specifically as it relates to your human capital. The standard FIRE playbook calls for an extremely high savings rate, often 50% or more, starting in your 20s and 30s. This is achieved through aggressive frugality and maximizing income in a stable, high-paying career. But consider the trade-off. Your 20s and 30s are the peak years for investing in your own skills, network, and earning potential. This is the period when your human capital, the present value of your future lifetime earnings, is your single greatest asset. According to a 2019 report from the Federal Reserve Bank of New York, the steepest earnings growth for college-educated workers occurs before the age of 40. Every dollar you divert from investing in yourself, whether that is for an advanced degree, a specialized certification, a calculated career risk like starting a business, or even relocating for a pivotal job opportunity, is a dollar that could have generated a far greater return than the market average. By optimizing solely for your savings rate, you may be systematically underinvesting in the very engine of your wealth creation, you. An S&P 500 index fund might return an average of 10% annually before inflation, but the right career move or educational investment can increase your income by 20, 30, or even 100%, a return that dwarfs passive investing in the early stages of a career. The relentless focus on minimizing expenses can lead to a dangerously risk-averse mindset, causing you to cling to a stable but capped income job rather than pursuing an entrepreneurial venture with asymmetric upside potential. The true cost here is the future, more successful version of yourself that you chose not to become. Beyond the financial opportunity cost lies the psychological toll. The journey to a high savings rate is not a passive activity. It is an active, daily process of restriction and optimization. This can cultivate a scarcity mindset that is difficult to shake even after financial independence is achieved. Researchers like Dr. Brad Klontz, a financial psychologist, have documented how our financial behaviors become deeply ingrained habits. The person who spent 2 decades optimizing every purchase and agonizing over every expense does not simply flip a switch and begin to enjoy their wealth. They often become what we call fearful savers, unable to spend the money they've accumulated, constantly worried about market downturns and portfolio depletion. They win the game but forget why they were playing. Chasing a net worth goal too hard can make you miss out on life. Don't skip social events. Good relationships bring happiness, so enjoy life while saving. This brings us to the technical costs, the complex, unsexy realities that are often glossed over in the popular discourse. The first is tax drag. Achieving financial freedom is not about your gross savings, it's about your after-tax, risk-adjusted returns. Tax loss harvesting means selling investments at a loss to lower your tax bill. A Vanguard study shows it can boost your returns by up to 0.75% a year. Next, we must confront the healthcare conundrum. For an early retiree in the United States, this is not a line item. It is a monumental financial hurdle. Before the age of 65, you are on your own. You must navigate the Affordable Care Act marketplace, where premiums can be substantial, even with subsidies. A 2023 analysis by the Kaiser Family Foundation found that the average benchmark premium for a 40-year-old was over $450 per month. For a family, this can easily exceed $10,000 or $15,000 per year, and that's just the premium. These plans often come with high deductibles and out-of-pocket maximums, meaning a single major health event could cost you an additional $5,000 to $10,000. Many in the FIRE community plan to manage this by keeping their taxable income low to maximize ACA subsidies. But this creates a dangerous paradox. You are a multi-millionaire on paper, but to afford healthcare, you must live a life of artificially low realized income. This constrains your spending and liquidity, forcing you to perform a delicate dance of Roth conversions and careful capital gains harvesting. It makes your retirement incredibly fragile and dependent on the whims of healthcare policy. This is a massive, ongoing, and unpredictable cost that the simple 25x rule utterly fails to account for. Then there is the beast known as sequence of returns risk. This is perhaps the single greatest threat to an early retiree. Standard retirement models are based on average long-term returns, but you do not experience average returns. You experience returns in a specific sequence. If you retire and are immediately hit with a significant market downturn, like the one in 2008 or early 2020, you are forced to sell assets at depressed prices to cover your living expenses. This permanently impairs your portfolio's ability to recover. Selling shares at the bottom has a much more devastating long-term impact than selling them at the top. A study by financial researcher Wade Pfau demonstrated that a portfolio could have the exact same average return over 30 years in 2 different scenarios, but if the bad returns come early, the portfolio fails. If they come late, it succeeds with money to spare. This return path dependency means that the 4% rule is not a static number. It is highly dependent on the market environment in the first 5 to 10 years of your retirement. Mitigating this risk requires a more sophisticated strategy than a simple 60-40 portfolio. It might involve building a bond tent, increasing bond allocation just before and after retirement, or holding several years of cash reserves, or using more complex options-based strategies to hedge against downside risk. Each of these strategies comes with its own costs, either in reduced potential returns or direct expenses, further complicating the simple math of financial independence. Finally, we have to talk about inflation in a more nuanced way. We usually think of inflation as that 2% or 3% number from the CPI, but no one experiences the average inflation rate. you experience a personal inflation rate dictated by your specific consumption basket. And the costs of the things that matter most, healthcare and education, have historically outpaced the CPI by a significant margin. According to the BLS, from 2000 to 2022, the overall CPI increased by about 75%. In that same period, medical care costs rose by over 130%, and college tuition rose by over 175%. If your financial plan is based on your portfolio outrunning a generic 2% or 3% inflation rate, you are systematically underestimating your future liabilities. A successful plan must account for differential inflation across categories. This requires a more dynamic asset allocation, perhaps with a greater weighting toward assets that have historically provided a better hedge against inflation, like real estate, commodities, or treasury inflation-protected securities, TIPS. It requires stress testing your plan not against average inflation, but against prolonged periods of high inflation in the sectors that will represent your largest expenses in retirement. Given these immense, often hidden costs, the opportunity cost to your human capital, the psychological burden, the tax drag, the healthcare labyrinth, and the technical risks of sequence and inflation, it becomes clear that the conventional model of financial freedom is flawed. It is a brittle, rigid goal that demands the sacrifice of your most productive and vibrant years for a future that is far less certain than the spreadsheets suggest. So what is the alternative? The alternative is to shift our objective from financial freedom to financial agency. Financial agency is not about escaping work. It is about gaining the power to choose your work. It's about having the capital base to dictate the terms of your engagement with the professional world, not severing ties with it entirely. It's the ability to say no to a project you don't believe in, to take a 6-month sabbatical to reskill, to downshift from a high-stress corporate job to a more fulfilling role, even if it pays less. It's the power to start your own business, knowing you have a financial cushion to absorb the initial lean years. This reframing changes the entire strategy. Instead of a single monolithic FI number, you build a tiered system of financial resilience. The first level might be a robust emergency fund, 6 to 12 months of expenses, that grants you the agency to walk away from a toxic work environment without desperation. The next level could be what the community calls Coast FI, where you've saved enough in your retirement accounts that, without any further contributions, it will grow to support a traditional retirement. Reaching this point, perhaps in your late 30s or early 40s, dramatically liberates your career choices. Your primary income no longer needs to be funneled into savings. It can be used to support a more intentional lifestyle or to take calculated professional risks. Beyond that, you might aim for Barista FI, having a large enough portfolio that you only need a part-time, low-stress job to cover your current expenses while your investments continue to compound. This is a state of immense agency, allowing you to pursue passion projects or spend more time with family long before a full traditional retirement would be possible. This approach, building wealth for agency rather than for escape, recalibrates the cost-benefit analysis. It encourages a balanced investment in all of your assets, not just your financial portfolio. The true assets that create a resilient and fulfilling life are your human capital, your skills and earning power, your social capital, your network and relationships, and your health. An intelligent financial strategy does not sacrifice these for the sake of an accelerated savings rate. It uses financial capital as a tool to enhance them. Money is used to buy back time, to invest in education, to nurture relationships, and to protect your health.